Welcome to our 2020 elections tax outlook and year-end planning webinar. My name is Tom Bayer. I'm with Sikich. I'm a partner in the Indianapolis office. And with me today is Jim Brandenburg. Jim is a partner in our Milwaukee office, and Jim is at the top of the class, as you can see, as he already has his Christmas decorations out in his home. So if you haven't thought about that, Jim's reminding us to get into the Christmas spirit. So thank you all for being here today. We're excited to bring to you kind of our post-election recap, and then sort of look ahead at what we expect to see in the coming months and years as we evolve to the new president. A couple things though, if you have questions, please use the question feature on the webinar control panel. And if we can't address all those questions, we will try to address them after the webinar and provide responses to the entire audience. The other thing I'll point out is the presentation slides can be downloaded from the handout section of the webinar control panel. So with that, I would like to welcome Jim Brandenburg, who will start us off. Jim.
Thank you, Tom, and thank you all for joining us today to review the 2020 election and the tax outlook from these elections. Again, 2020 was one of the most publicized, expensive, contentious elections in many years, and many of you have followed the races, but let's just take a review of the results here from the election. Again, for president, former Vice President Joe Biden has defeated President Trump with 270 electoral votes needed. Biden now has 290. President Trump has 232, and there's still one state undecided, to Georgia, with 16 electoral votes with it. I know that there are still some votes being counted, some recounts, even legal challenges, but again, at this point, Vice President Joe Biden has won with it. Again, the Electoral College will actually meet in December, cast their ballots. The Senate counts those early January, and then the inauguration is scheduled for January 20th. Let's look at the Senate here. Senate was very interesting. Again, going into the elections, the Republicans had a 3-seat margin going into November elections. The Democrats had a net pickup of 1. So where we stand now is the Republicans have 50 seats, the Democrats have 40, but there were 2 seats. Again, there are 100 seats in the Senate, 2 seats that are undecided, and those are in Georgia. Georgia has a special rule with their elections. You need to get at least a majority in the election in November. In both, they had 2 Senate races in Georgia. Both of those did not have one of the candidates get at least 50% with the election, so they have a special runoff race for both those Senate seats, and that will be in Georgia on January 5th. So if what happens with the Senate then is if the Democrats sweep and win both those Georgia runoff races, then the Senate will be at a 50-50 tie. New Vice President Kamala Harris will then cast any tie-breaking votes. If the Republicans win one or both of those Georgia races, then the Republicans will control the Senate. And we'll talk about the significance of that as we move along here. And then in the House, Republicans have picked up 6 seats at this point. The makeup now is the Democrats have 219, Republicans have 203, and there's still 13 races that haven't been called or decided yet. So the Democrats will still control the House, but with the narrower margins than they had before the elections. So again, just some overview. There was a predicted blue wave you may have heard about that didn't materialize to the degree that some had thought. But again, if the Democrats sweep those runoff races in Georgia, in early January, the Democrats will control not only the White House, but the House and the Senate, at least as a 50-50 tie, again, with the Vice President casting that tie-breaking vote. So they will have a control in all 3 branches, the House, the Senate, and the White House with it. So again, Georgia will be on everybody's mind as we come to January. significant races that will be coming up here. So those in Georgia, they thought that all the campaigning was done in November, but they're going to have another probably 6 weeks of campaigning going into those runoff races. But besides the federal elections, there were a number of state ballot initiatives around the country, and we thought we'd just highlight a couple ones that had some tax impact. And Tom's going to just address a couple of those state ballot initiatives around the country. Tom?
Thank you, Jim. A few states that had some significant ballot initiatives. Illinois had what they called the fair tax proposal. The fair tax proposal on the ballot it was a constitutional amendment to change the flat tax to a graduated tax rate. And they had already passed a law that had this constitutional amendment passed, that tax increase would have gone into effect in 2021. It was defeated 55 to 45 by a 55 to 45 margin. In California, in Arizona, alternatively, they did in fact pass a pretty significant tax increase. The funds to be directed to education in schools. So it passed by a narrower margin of 4%, as you see. In California, the formula for property tax values to increase the property tax values to current values, expected to raise about 7 to 11 billion. That was defeated. Notably, one of the more publicized propositions in California, it was also approved, Proposition 22, which was really favorable for a lot of the gig workers, the gig companies like Uber, and it allowed those workers to continue to be classified as independent contractors. You know, it's notable that these are all blue states, and you know, 2 of the 3 states here with some significant tax proposals, the electorate turned those tax proposals down, those increased proposals down. The other thing I'll point out is just this morning, one of the things we're going to talk about a little later is, you know, the status of the stimulus and what we might expect for the balance of 2020, 2021, whether or not there will be a stimulus, and some other key provisions that have been discussed. But if you followed that story at all, one of the issues which has been fairly contentious in Congress is providing additional aid to state governments, and the Republican caucus was opposed to that, and the Democratic caucus was supporting that. So that was one of the obstacles to get a bill passed, as you might know from following that. This morning, the Wall Street Journal was reported in one of the editorials that sales taxes and income taxes in these states really aren't as bad as one might think. And specifically in California, as an example, October sales taxes were up 9.2% for October 2020 over October of 2019. So 9.2% increase. And then year to date, which was an interesting number, income tax receipts are up 18.6% in California, which is about $9.9 billion. So state governments and the impact of the pandemic is not as bad as we might believe, you know, based on, you know, a lot of the other economic metrics that we follow. So those are just a few specific facts and observations on some of the states, Jim.
Okay. Thank you, Tom. Now that the elections are over, or at least except for the Georgia runoff races we talked about, let's look at what to expect for possible tax changes, you know, with the new administration, new Congress. We're going to look at Joe Biden's tax proposals, but also some other factors in Congress that will impact any tax legislation, not only next year, but over the next coming years. First, we're going to look at Biden's tax plan for businesses. Again, he's got several proposals out there, you know, for businesses. The first that he has advocated is to raise the corporate tax rate from 21% to 28%. Again, that's a 33% increase. Again, these would be for what they call C corporations, a proposed tax rate increase. The other thing that Biden will look at is what they call a corporate minimum tax of 15% on a company's book income, or what's on its financial statements. Again, these would be for larger corporations. Haven't set all the thresholds or the specifics with this change. What's uncertain is there used to be what they call a corporate AMT, or alternative minimum tax. That ended in 2017 with the tax reform bill in 2017. So it's unsure if this new corporate minimum tax would be somewhat similar to that, or something new that would be developed by Congress for that. So that would be, again, an additional tax that could be imposed on corporations. Another one is this proposal is a hike or an increase in the what they call the Global Intangible Low Income Tax, or GILTI. And that was a tax that came, again, with the tax reform bill in 2017 for corporations that would be taxed on their earnings that exceeded 10% of their corporation's foreign assets. So if it's got a controlled foreign corporation that it owns overseas, there'd be a tax that was approximately at 10.5 to 13%, that there would be a tax, this GILTI tax that corporations are subject to now. Biden's proposal would raise that to 21%, so it would pick up additional income for companies that have foreign subsidiaries with it, and it really double what that GILTI tax is. A couple other things that the Biden proposal, one would be one that would actually be an incentive, or perhaps a benefit for companies, but not much in the way of specifics with it at this point. It would be some manufacturing incentives, again, to try to create a demand for U.S. products. They'd look to have some incentives or credits for manufacturing facilities, and perhaps also to expand some of the R&D incentives. So for any manufacturing companies out there, it's something to keep an eye on, is to see what specifically is included in those incentives. Last, with foreign taxes, one of the things that Biden has indicated is to lessen any motivation for outsourcing jobs overseas. And again, we'll see what specifically is involved with that. So these are some of the corporate proposals that Biden has sought or advocated as a candidate, and would look to try to implement those as president. Now we'll look at some of the individual changes, again, that would apply, or that he's would propose. First is for the individual tax rates, to move that top rate up from 37% to 39.6%. And Biden has indicated, again, that these tax increases would apply for individuals with over $400,000 of income. Another change would be with capital gains. And this would apply for capital, long-term capital gains and qualified dividends. Again, those get a favorable rate now of 20%. That would be eliminated. They'd be taxed as ordinary income again, so they'd be up to 39.6. That'd be for taxpayers with over $1 million of income. So that would be a tax rate increase for capital gains with it. Another thing that came about in the tax reform bill, the Tax Cut and Jobs Act in 2017, is this small business deduction, Section 199A. Some of you may be familiar with, and what that does is reduce the tax for those small businesses that qualify. It's a 20% deduction that companies get. And what Biden proposal would be is to scale back or remove that 20% deduction for those with income over $400,000. So what that would do is, right now, a company that qualifies for that deduction, if it's in the top rate of 37%, is really taxed at 29.6%. What would happen, though, if Biden's proposal went through, though, is not only would they have a higher rate of 39.6, but they wouldn't have this 20% deduction, again, to the extent their income is over $400,000. So that's a significant increase to go for small business or closely held business, to go from 29.6 to 39.6. Again, for those over $400,000, that's, again, about a 33% increase, similar to what's happening with the C corporation. Another Biden's individual proposal is a payroll tax hike. And this would apply for those with, again, over $400,000 of income. Now, you may know with your Social Security, your FICA tax, the 7.65% applies up to around $140,000. And then only the Medicare tax applies at 1.45%. And that applies all the way through. What Biden's proposal would be is that once your income then got over $400,000, that 7.65 would apply again. Both the FICA and the Medicare would apply at 7.65% above $400,000. And some have referred to this as a donut tax, so that you sort of have that higher rate at the bottom end. The middle part, you don't have that 7.65%. It goes down to 1.45, but then the higher rate kicks in again above $400,000. So that'll be another proposal that it'll have. Real estate, one of the things that's common with real estate is what they call like-kind exchange. So if you dispose of a real estate property, you can take the proceeds from that, roll it into a different property, and avoid recognizing the gain with that. Biden would eliminate that for those with over $400,000 of income, not be able to use a like-kind exchange. So that would have a potentially significant impact with those in real estate. Unsure of the details and how it might apply if there's a pass-through entity, a partnership perhaps that has real estate, has a number of partners or members, LLC members with it, how this would apply in that situation, if that would pass through to them or if the partnership would be subject to it. Again, we'll have to see what the details may be on what that proposal is. These last two are kind of interesting ones that Biden had is, again, we talked about the potential higher tax rates, again, up to 39.6. But what they would kind of do is split the income. So your income would be taxed at that higher rate of 39.6, but then your itemized deductions, you wouldn't get that same 39.6% benefit, that they would cap those or scale that back to 28%. So for those in the higher income, they're going to tax your income a little higher, but on the deduction side, you're going to get less of a benefit on that. So again, that's just an additional tax increase that for those with itemized deductions. On the flip side, one thing that Biden would have is retirement savings that would provide an incentive for lower income workers in the lower and mid brackets, that they would receive a little higher benefit. So instead of being maybe in the 15% bracket, if they contributed to a retirement account, they may get some type of a credit or incentive that might be at a 25 or 30% benefit to try to encourage them to contribute to a retirement account. So their income is taxed at maybe a lower rate, but the deductions receive, at least some of the deductions receive a little higher benefit. So it's something that will be interesting to see how both of those play out again in any proposals. Now we'll switch over and Tom will look at some of the estate and gift and wealth taxes that Joe Biden has. Tom?
Thanks, Jim. A couple things. You start to see some policy playing out in some of these proposals, right? There's been, remember that the Secure Act was passed the end of last year with a lot of retirement plan provisions in it, right?
Right.
Things like credits for businesses to set up retirement plans within the first 3 years. So those credits are fairly significant, and they offset administrative costs to set up plans and maintain plans, because there's a lot of documents involved in establishing those plans and some fees involved. And so you can see here that there's additional credits being discussed in Biden's tax plan to do that. Where this is going, and one of the policies that I think we're going to see a lot of discussion about is how to fix Social Security and Medicare. And of course, these incentives, these credits, these tax breaks are all designed to help workers save for their own retirement, to be less dependent on Social Security. And Medicare is a different story. Prescription drug costs and the cost of healthcare continues to rise at pretty significant rates. But one of the policies and one of the things I think that might be a focus of a Biden administration is to really try to establish a fix to the Social Security and Medicare funds, which, as we know, are financially distressed and as we go into the next decade. So, but in terms of wealth and estate taxes, as it relates to retirees, retirees do rely on Social Security, and so we expect to see over the coming years, and maybe not in the next 4 years, but at some point, there's probably going to be some changes to Social Security, and Jim mentioned too in the previous slide, increase to Social Security tax for those over 400,000. A lot of these Biden proposals focus on higher income, and that higher income threshold, at least so far, appears to be at that $400,000 mark. So at $400,000, you can really see some of the tax proposals start to impact taxpayers. But in terms of TCJA changes, one of the things that was a huge benefit of the Tax Cuts and Jobs Act that was passed at the end of 17, effective 1/1 of 18, was the increase to the estate tax exemption to 11.4, and it continues to go up, indexed for inflation. An exemption for married couples is double that. So these higher levels, remember, if nothing changes, are scheduled to revert back to 5.45 million for per person in 2026, right? They sunset. So Biden may push one of the things that's being discussed for a lower exemption. 5 million is listed in this slide. There's also some talk of 3.5 million being that new exemption number. So we'll wait and see. Perhaps, as the slide says, perhaps 2022 or perhaps even 2021. So there's also talk of raising the top state tax rate from 40 to 45%. So additionally, the step up in basis that those who inherit assets realize upon the death, those beneficiaries would no longer get a step up in basis, right? So if you own stock in General Motors, your dad owns stock in General Motors, and you inherit that stock, you get a basis step up at his death to the current value, which is a great benefit. And then finally, there's some talk of a wealth tax being proposed by the Democrats, by President Biden. Really not a lot of details on that, except that if you have a lot of wealth, you may end up paying a tax on that wealth each year. So those are some things to look for in a Biden tax plan as it relates to wealth and estate taxes, Jim.
Okay, good. Thank you, Tom. Yeah, a lot that's out there, and again, some general direction, but not obviously some of the specifics with it. What we thought would be helpful now is that, again, well, we've covered some of his proposals, both for business, individual, and wealth taxes. Just recall that, again, a president, can offer proposals, but the actual tax bills need to go through Congress. Again, there's much involved in getting a tax bill through Congress, and comprehensive tax reform does not happen that often. Again, 2017 with the Tax Cut Jobs Act, again, was significant tax legislation, comprehensive reform. And again, the last major reform before that was 1986. So we do get tax changes, on a somewhat regular basis. Some are more major than others, but comprehensive changes just do not happen that frequently with it. So even though Biden has these proposals out with it, it doesn't mean that all of those are going to get enacted right away with it. That just sometimes it doesn't work that way as far as having comprehensive changes. One thing to keep in mind with this too, as we move along, is that, again, Congress is going to have a key role with this, and it's important to know that we've got the tax writing committees in both the House and the Senate. They have their own ideas too. They may be the same as what Biden has. They may differ with it, but they're going to have key parts in any legislation with it. And then, pushing legislation through the House is not an easy process. Again, especially if there's some tax increases that might be pushed in that for certain either individuals, businesses, certain industries. Again, and recall we talked before that there are narrow margins in both the House and the Senate. Again, even if the Democrats do get control in the Senate, again, it's going to be in a 50-50 situation with the vice president casting perhaps a tie vote there. So again, not much margin for error as far as them trying to pass legislation. And really any tax bill that makes it all the way to the president's desk, to Biden's desk, he would probably need to support and accept it. It's not going to be 100% of what he wants. It may be half of what he wants, and it may be some things that he might not want, but he's going to have to accept really whatever gets through Congress. He's going to have to take it because, again, those pushing the bill through Congress know what can get through and what might not get through, and that's a part of the process they go through. We thought we'd just list out again, some of these names may be familiar to you, but these are some of the key leadership ones at this time, both in the House and the Senate. Again, we got the leadership positions that are key, but then the what they call the tax writing committees in the House. Again, Richard Neal is the chairman of the Ways and Means Committee. Kevin Brady, who really helped author the Tax Cut and Jobs Act, is the Republican ranking minority member there. And then the Senate Finance Committee, Chuck Grassley is the Republican leader, and Ron Wyden is the Democratic leader. Again, as they get tax bills legislation moving forward, these individuals have a key role with it, along with leadership in pushing bills, through Congress with it. So if you've heard some of those names, if they offer some suggestion or proposal with it, it's going to be something to make sure you make note of, as opposed to perhaps somebody who's just a new member of Congress in the minority party. They could put a proposal out, but it may not move too well. Whereas if you see one of these leaders on any of these tax writing committees, they have a little more say of what's going to happen with it. So again, I think it's important to get the lay of the land with what's going to happen with Congress, coming into some of the new legislation that's out there. Tom's just going to go through again. We're looking at possible new legislation, and again, we had the Tax Cut and Jobs Act just a few years ago in 2017. Some of those items, however, are going to either sunset or be scaled back. And that's going to be right during the time frame of when they're looking at possible new changes. So Tom, why don't you go through some of these looming tax provisions that Congress is going to have to deal with?
Okay, Jim, we had one question come in. I thought it would be a good time to address it. And the question is, are all of these tax policies or these proposals, are they all anti-business? And I'll just weigh in and be interested in your thoughts, Jim. But, I think the pro-business policies are going to be directed toward what Congress, what the president wants businesses to do, right? Invest in research and development. Invest. It's probably a lot around the pandemic, right? Invest in safety protocols and PP&E to protect their workers. Credits to bring workers back to work. I think it's going to be. I think the pro-business provisions that we'll see will be around how do we recover from the pandemic. So I do see some quote unquote pro-business policy here. Jim, what do you think?
Yeah, I think they'll be trying to have some of that with it. I think the higher rates though with it, again, whether it's the C corporation rate going up potentially, or for the pass-through businesses going up from 29 to 39 or close to 40%. Again, with some of the closely held businesses, set up as S corporation or partnership, to the extent that the tax rate goes up that much, I mean that's less money available for that business to hire new employees or to put money back in and expand the business, or to put new machinery and equipment and grow the business. So as they do raise the taxes on it, it may have an impact on some of these businesses trying to not only stabilize their workforce but expand their workforce because of the additional taxes that they're looking at. So I think it's a little mixed there with it as to what the outlook will be on it there. And again, these small businesses are the ones that again do a lot of the provide a lot of the employment in the country with it. And again, as they're I think they fueled a lot of the economic growth the last few years, and if their tax obligation or their tax liability goes up, it may limit their ability to expand and grow their employment there. So it's something we'll have to keep an eye on.
So back to the presentation here, looming tax provisions. Remember again that a lot of significant tax provisions from the TCJA will start to sunset. Some of them are going to start to phase down or change and evolve. And one of those is this interest expense limitation under Code Section 163J. The formula for what's called adjusted taxable income is going to change in 2022. And effectively what this, what I call this provision is the balance sheet management provision. So what I think what the Congress and what the president were trying to do with this was, you know, if you have a lot of debt and a lot of interest expense, limit the amount of interest expense that was deducted. In other words, maybe as a business, some of those investments should be made with equity, which I think is one of the goals here. Unfortunately, if a business has a down year in income and they do have some debt, those 30 and 50% limitations of the amount of interest expense deductible on what's called adjusted taxable income, it reduces the the tax deduction they get in the current year. It's carried forward, but just remember that interest expense limitation is going to get it's going to change after 2021. The 100% bonus depreciation starts to phase down, right? It's 100% right now, starting in 2023. So you really have 2 more years of 100% bonus, and then it starts to phase down basically at a 20% rate each year until 2026. R&D expenditures, generally deductible when incurred, starting in 2022. There's a 5-year amortization, so that will change as well, slowing down. And this is all really part of the, the budget reconciliation, where they had to build in some revenue raisers into some of the benefits, and it had to be somewhat of a tax neutral within a limitation, a tax neutral bill. And then individual tax rates, and the itemized deduction, personal exemptions, all those sunset, all those new rules sunset in 2026. And then, the 20% QBI deduction, which Jim talked about, that Biden could potentially change, that also sunsets in 2026. So a lot of things are going to change here, regardless of any potential new legislation that we have to think about as we do tax planning.
Good. Yeah, and again, as you noted here, Tom, that again, some of these changes from the Tax Cut Jobs Act were just some of those I mentioned before. This budget reconciliation, there are some real strict or complicated rules within especially in the Senate, to try to get your tax bill through, and they needed to sunset some of these provisions. They couldn't make them permanent, and that's again, it pushed the deduction down the road. Again, that's going to be something the Congress is going to have to deal with, whether it's 2021, 22, 23. These issues are going to come up and be some significant changes that Congress is going to have to deal with. Even if they don't pass any separate legislation now, these are issues that are coming down the road here pretty soon. Again, as we're looking at the sort of the legislative prospects, for tax reform, again, we've got what Joe Biden, Vice President, soon to be president, his suggestions, his proposals. We've got some of these, carryover, these looming items that need to be dealt with by Congress. We've got, again, some of the new rules and the new, key players in Congress that are going to be, driving the legislation there. But again, I think the key thing is really what's going to happen. We talked about before in Georgia. Again, those 2 Senate races, and we kind of put this slide here, and then the next one. Again, with those 2 Senate races in Georgia in early January, if again the Democrats sweep those, they will have a 50-50 tie, and then Vice President will cast that. That will be significant. They will have all 3 branches, if you will, the House, the Senate, the President, and again the prospects for major changes are more likely. They might not be as significant as the Tax Reform Act in 2017, but could have some significant tax changes if they sweep those Senate races. If the Republicans win 1 or more of that, they're going to control the Senate. the chance for major changes are less likely. Again, you're going to have a split there. You may have some changes, but nothing quite as significant with it. I thought this chart here actually helped, kind of, put stuff sort of in perspective as to what to expect here. Again, on the left side is when it says Democrats, that's would be if the Democrats sweep those 2 Senate races in Georgia, what to expect on a couple of these categories. On the right side is if the Republicans win one or both of those races in the Georgia, those runoff elections, they will control the Senate, and then what would happen with taxes. So let's look at it. Business taxes, again, if they sweep those races, again, look for that corporate rate to go up from 21% to maybe 25 to 28%. Again, Biden was looking at 28, but look for an increase there. If the Republicans win, however, I think it'll stay probably at 21. May go up a little bit, but then those if they do hike it some, it may be as a trade-off to maybe continuing the 100% bonus depreciation that Tom talked about, or that interest expense. So there may be just some negotiations that Republicans accept maybe a higher rate, slightly higher rate, to get the 100% bonus depreciation that businesses are interested in. Individual rates, again, look for the rate to go up from 37 to 40, and then possible reduction or repeal of that 20% small business deduction that we talked about earlier. Again, if the Republicans control the Senate, I would not look to see the top rate move much from 37%. And I also would think that 20% business deduction would likely be retained. Capital gain taxes, again, look for perhaps a push for that. The House will go for that. That may be a little more difficult in the Senate to get a capital gain rate, even if the Democrats control the Senate. But if the Republicans control the Senate, even though the House could move a bill with higher capital gain taxes, it would likely not survive in the Senate. So there's an issue. The next one we haven't talked about yet, but it's something to be aware of, and we'll talk on this a little bit more later too, is the SALT deduction. It's a state and local tax. And this was one of the changes from the Tax Cuts and Jobs Act, and it put a limit or a cap on your state income taxes that you itemize deduction to $10,000. And that's been controversial since it was enacted for some states, New York, New Jersey, California, that have higher property tax and state income tax. Residents in those states are limited to $10,000. If the Democrats control the Congress, both the House and the Senate, look for that $10,000 cap to either be removed or significantly expanded, increase quite a bit, so that more of those state and local taxes could be deducted. The Republicans were the ones that established that SALT limit, with the Tax Cut and Jobs Act bill. They might part with that, however, if it maybe came with a trade-off on, let's say, again, this bonus depreciation or maybe the interest expense deduction being allowed. So there could be some, horse trading with that to say that they might allow that SALT deduction to maybe go up to $20,000 or $30,000, but maybe we'll continue the bonus depreciation. So that's something to keep an eye on. Again, if the Republicans control the Senate, they may try to, push a change with the SALT deduction. Estate and gift taxes, again, look for Congress, if the Democrats control that, to try to accelerate the scaling back on that exemption with it. Perhaps also look at that step up in basis. That may have more difficulty getting passed, but those are two items that Biden is looking at. I think the Democrats are going to push for those. And if the Republicans control the Senate, again, I don't see that significant estate tax changes happening in the next Congress then. So again, this is just sort of a snapshot of some of these provisions, again, just depending on what happens in Georgia with it. Again, with the Democrats, again, sort of the left side as to what they would do, probably have more chances to get major tax changes allowed. If we do get the Republicans controlling the Senate with winning at least one of those races in Georgia, then less likely some major changes, but there could be some that we'll have to look at. So anyway, I think this was a good overview of what to expect in the coming years with Congress. Okay, having looked at that now, okay, we got a little picture as to what to expect over the next couple of years. What might be some things to look at for some 2020 year-end planning, something from now to the end of the year take into account what we have here. So a couple thoughts on this here. First is, again, it's kind of hard to do some planning because we won't know until January who's going to control Senate, but there's still some things to look at. One thing to note that, again, even if the Democrats do control the Senate, win those two races, and they push a bill again, that's going to be a involved process to push that bill through. Even if it does pass, it's unsure when it would be effective. Many people have speculated that if they get a tax bill next year, it's going to be a retroactive beginning of the year. That's a possibility, but in the past there haven't been too many situations we've had retroactive tax increases. The last one they recall was in August of '93. There was the tax bill passed in August of that year, was retroactive back beginning of the year. It had some tax hikes with it. Oftentimes, however, it may take it may take till the middle of the summer or even to the fall to get a tax bill passed, and at that point they may make it effective in 2022. So just the fact that they do a tax bill doesn't necessarily mean that it will be effective right away. So that's just something that we'll have to keep an eye on. But it does lead to still some businesses and individuals are looking at, what should they do before the end of the year. And Tom's going to look at some business planning that you could explore here for the balance of the year. Tom?
Thanks, Jim. Some great questions coming in here, so we'll try to get through our planning slides and address those questions. One question that came in was the 400,000 threshold, whether that was AGI or taxable income. The answer is we really don't know for sure, but generally they peg those numbers on AGI. If in fact some of those proposals come through, I'll just address that real quick as we move along here. And but back to our slides here. One of the things you got to remember is it's fairly simple, but sometimes I like to remind myself is the tax revenue is there. There's two parts of the formula. There's the base, and then there's the rate. And Congress focuses on the rate. When in fact, there are some signs that manufacturing and distribution are actually growing in this country. There's a higher demand for a lot of industrial commercial real estate, really driven by some manufacturing moving back to the U.S. I think distribution, because of the e-commerce, is a growing industry. So there are some signs that the actual tax base is getting better. And I think, again, if we go back to an earlier comment about tax revenues not being off as bad as we might think in states, I think those are all signs we see. But in terms of our year-end planning here, one of the big issues is the NOL carryback that was part of the CARES Act. It expires at the end of 2020. So when the CARES Act passed, we could carry back losses from 18, 19, or 2020. And of course, we don't know what 2020 looks like until that year ends. But if you're a business, if you're a flow-through business or corporate C Corp that has a tax loss in the current year, the question is, do you carry that loss back 5 years or do you carry it forward? And there's no easy answer to this. Because as we sit here, we anticipate potentially tax rates going up. We don't know how long the pandemic will impact our business. Will we have a banner year in 2021 or beyond where carrying forward a loss will generate more tax revenue for us? So it's really the rate of what I call the rate of tax refund that we need to calculate, and we need to project to determine whether or not to use that NOL or carry it back. And the other question is, if we're sitting in a position where it looks like we're going to have a loss or be close to a loss, do we actually, accelerate some deductions or defer some revenue or do an accounting method change that might actually enhance that tax loss, with the idea that we could capture some cash flow from tax refunds if we carried those losses back? So let's go to the next slide and look at an example of this. If you expect it, ABC expects to incur a tax loss of $1 million. And when we look at the carryback and what tax we paid in prior years, we come to a blended rate of about 25%. So the tax refund, $250,000. If corporate tax rates are going up in the future years, and we have reason to believe that there's high likelihood that'll happen, well, maybe we can actually increase that the value of that NOL if we carried it forward, right? If we carried it forward into a year where the rates were higher and we actually had income that we paid at those higher rates at 25, 28%, maybe higher, it might be a better decision to carry that loss forward. So, those are scenarios we need to work through and determine what the right decision is. And again, whether we should, in the case of businesses that were severely affected by the pandemic, should you do things to maybe enhance that loss to try to get as much tax refund as you can from the prior 5 years. Let's go to the next slide here. So if a company's profitable in 2020 and will be in 2021, again, if it has expenses that could be deducted in 2020, maybe accelerate those. And the other opportunity maybe is to take bonus depreciation in 2020 or accelerate some CapEx that maybe were going to happen in 2021. Maybe we accelerate those into 2020 to, again, think about enhancing that loss. So these are all situations to sort of analyze and look at to see if, what we can do to, tax policy is a lot about cash flow. And so we're always looking at how do we mitigate tax impact so that we preserve cash flow. But in this case, we have an opportunity that really expires at the end of 2020 to potentially make some decisions to enhance our cash flow because of the NOL carryback opportunity.
Yeah, good. And one of the things with that too, Tom, is the some of these things you can do by 12/31, but some could be on your 2020 return that may not be filed until March or April or even all the way to late in the summer.
Yeah.
And then by then you're going to find out, okay, what's going to happen with any tax proposal then? You're going to say, okay, well, the rate is going to be increased, or maybe it's not going to be increased. So that may then help, drive your decision on what you do maybe on that 2020 tax return then. So it's something that you can analyze now, but you may not necessarily have to make a final decision on that until you get ready to file. And then, you should have a better, clearer picture as to what direction, tax changes have next, this coming year.
One of the major questions that we get is when is it likely tax rates will change? If you look at the environment today, I would expect that we're going to be addressing the implications of the pandemic for quite a while into 2021. So I would look at the second half of 2021 before we really start to see some of the new president's priorities come out, whether it's climate change or Social Security, Medicare, or maybe some tax law changes. There's talk of a big infrastructure bill that needs to happen. So I would really, expect that we wouldn't necessarily see a retroactive tax increase to the beginning of 2021, but that's just purely from, us, reviewing and listening to what other strategists out there say about what they expect.
Good.
So I think we've talked about all of these situations here, Jim.
It's just kind of, I think the point is it does give us a little time after the end of the year to see what's going to shake out in the new Congress and with it. A couple individual items with it here, to follow up what you mentioned, Tom, is individuals also could have exercise what to do before the end of the year. Again, if we have possible tax rate increases, again, if the rates do go up, the Democrats do control Congress and push for rates, would those be effective in 2021 or maybe 2022? It's something we'll have to look at. individuals may not have as much time to deal with that. There may be some things to do before the end of the year. Now, if they have a pass-through business like an S corp or a partnership, again, there may be some opportunities with those businesses to adjust your income when they file those returns. But there's some other decisions they may need to do by the end of the year here. Um, and it makes it a little challenging because you may have to do something by December 31st, and you may not know the control of Congress happens until in January of 2021. So you're not necessarily dealing with full information as to what's going to happen in Congress. Here's a couple things to think about for individuals with it. Um, an individual has a large capital gain and thinks that it may change in 2021 or beyond. They might want to recognize the gain in 2020 to lock in that rate at 20%. By doing this again, however, they're going to accelerate the tax earlier than they may have planned. They might not have planned to sell it now, but they want to lock in that rate. And again, what if capital gain rates don't change and whatever? Well, that's something they're going to have to look at. So that's one thing to have. And if somebody had an installment sale, let's say had an installment sale with a gain in 2020, one thing that they could look at with their tax return is when they file that 2020 tax return, if they had an installment sale, they could see if there's any increase in capital gain rates coming down there, and then they could what they call elect out of installment sale and have that whole gain recognized in 2020. If, however, there's no capital gain changes, then they could let the installment sale work and have that gain recognized over a several year period. So that's something that you could actually look at on your 2020 tax return for it. And here's on the SALT deduction that we talked on before. Again, as noted, there's this $10,000 limit. And again, if a individual has already exceeded that $10,000 for the year, either in their property tax or their state income tax, what they could look at is if they had a payment here before the end of the year, whether it's a state payment or a property tax, they're already above the 10,000. They really aren't going to receive any more benefit in 2020 for that. If they hold it off until 2021, then what they might be able to get is what if that SALT limit does get scaled back, either whether the Republicans or the Democrats control the Senate, they make a change and make it effective in 21, they might get a benefit a benefit for that additional amount. So it's something to look at. If you do have a payment at the end of the year, if you defer that, you might get a benefit. I'm not promising it, but if you know you're already above 10,000, you're not going to save anything in 2020. So that's something to look at. And then Tom, just as some year-end items as far as some individual with some maybe estate and gift items.
So one of the things to remember, if you're an individual and you're a lot of your income maybe comes from a flow-through business that you own or that you invested in, and it's showing reduced income because of the effects of the pandemic in 2020. Think about what bracket you're going to be in 2020. Maybe one of the things you could do is we always try to get clients to pay taxes in lower brackets. Consider a Roth IRA conversion, right? It might be a year to do that, given that you may be experiencing a lower bracket because of, frankly, just the effect of the pandemic on income, maybe on dividends, that you have a large investment portfolio. So look at that, do some planning before you're in, and look at the tax bracket you're in. In terms of individual estate and gift, obviously everyone's looking at the potential estate tax exemption going down. So there's a lot of clients are looking at doing some gifting before year end to take advantage of the higher exemptions, and using that, making gifts to children or grandchildren, setting up trusts. There's a lot of popularity in the potentially defective grantor trusts. If you don't know much about those, reach out. We can provide some information. Grantor retained annuity trusts with interest rates. The federal published 75/20 interest rates being so low, it's a great time to do a GRAT. So these are all good things to look at. And again, consider the idea that potentially in the next few years, the exemption goes from 11 11.5 inflation adjusted down to potentially 3.5. So a major change. And so there is an opportunity here, but you know, there's a lot to think about when you start thinking about gifting. Jim?
Good. Thank you, Tom. Okay, just a follow-up on some other items here that, again, we're looking at legislation going into 2021 and the new Congress with it. Again, that'll be important, and with the president and the new Congress here. But there's a couple other things here that, again, some follow-up we talked about before a little bit. With the CARES Act and possibly some other legislation. So we thought we'd just go through just briefly here. A couple items on the PPP loan. Some of you may have even had businesses that have a PPP loan or looked at it. Just to review some of the issues with that, and then also just a discussion too on possible legislation even before the end of the year with some additional stimulus. Again, this PPP loan again was an important part of the CARES Act to get some funds out to businesses that really were affected with the shutdown last March and April with it. And again, what Congress said is that and that not only did you get the funds for the PPP loan, but that loan would be forgiven if you use it for the right sources, but you wouldn't have to pay tax on it. So it was a real nice setup for the businesses with it. Well, then shortly after that, the IRS issued this notice that we indicated 2020-32 that said, okay, well, if that debt that you have is you don't have to pay income on that, but we're not going to let you then deduct those expenses. Okay, so that's what the IRS ruled, and they said, well, it's tax exempt income, so it's not going to be deductible. So legislators in both the House and Senate, and I think in both parties, were surprised that the IRS took that position with it. And they said, well, why would that be not deductible if the income is exempt? Again, if we'd get the same treatment if we not put that provision in to make the income exempt. That just didn't make sense to a lot of the legislators. So they wanted to provide a benefit for them by exempting that forgiveness, but still allowing the expenses to be deductible. But they realized that when the IRS made that determination in this notice, that they're going to need some additional legislation. Okay, so Congress is aware of that. And this is still something on Congress's radar, even though it's been a number of months since they passed that CARES Act. They still would like to get that done. They had a couple efforts this summer that didn't make it, but there's still some possibilities this year that this could be done. We'll talk about it, a possible another stimulus legislation in a minute here. It could be attached. It could be part of that bill. There is some other legislation near the end of the year that Congress still has to deal with here in 2020. There's a omnibus spending bill they've got to do in December that could be attached perhaps to that. There could maybe be just a standalone bill that addresses PPP expenses. So it's something to keep an eye on. Again, there's a lot that Congress has to consider as it winds down sort of in this lame duck session, but it could be something that they incorporate into it. We're just not sure if that's going to get done or when any legislation is going to move forward this year with it to include this PPP expenses. But again, for those who have those loans, these are significant amounts they're looking at, hundreds of thousands or millions of dollars of whether they can deduct those expenses or not. And it really has a big swing in their income in 2020 or 2021. And then Tom's just going to address, what the IRS has been looking at as far as with the PPP expenses and the treatment of that and the timing of that.
So some good questions here on PPP that we've gotten. With regards to PPP loan forgiveness, tax implications, is there any further guidance, or when could we expect IRS guidance rulings on whether these expenses will or will not be deductible? Great question. And if I had a crystal ball, I would share that what that crystal ball said. The couple things that we recently came out in some guidance that I will share. So, Chief Counsel Michael Desmond, quote, I would stay tuned and see what may come out of that in terms of all the questions. I've heard a lot. They're hearing that there's a lot of guidance. The AICPA, which is our professional trade association, they work closely. They've been working closely with Treasury and SBA on the PPP since it came out. Treasury officials telling them anticipate additional guidance before the end of the year and possibly by the end of November. Generally stating that if a borrower has a reasonable expectation of loan forgiveness, the expenses can't be deducted to the extent they're paid for with the loan. Okay, that's true regardless of when the loan is forgiven. Okay, so that's kind of verbally a quote that we had in some recent guidance. We've talked to the IRS about this issue months ago, and their position was basically that when the expenses were incurred is when you should sort of add them back and not deduct them. So we've talked to others, other professionals, other entities, and their legislative liaisons. There was great belief that after the election, something would come out on this, that Congress would act in a standalone piece of legislation. As Jim said, I think December 11th is a key date. I think that's the date that if the Congress does not pass a budget extension, if you will, I may not be using the exact right terms, that the government will have to shut down. So Congress has to act on that, we think, to avoid government shutdown. The question is, will they, as Jim refers to, will it be a Christmas tree bill where they add a lot of other provisions to that bill to try to get loan forgiveness as a part of it, or potentially other stimulus measures. So we don't know the answer. I think the interesting thing here is, if the borrower has a reasonable expectation of loan forgiveness. Recently SBA issued some forms that for those that received loans of more than $2 million, you have to document loan necessity. The form asks a lot of questions about, Q2 results, Q2 of 2020 results, liquidity, asks a lot of different questions. I believe that form creates a lot of uncertainty as to whether the SBA will actually approve that loan forgiveness. So my worry is that the SBA will in fact disallow some forgiveness for certain borrowers, and that will happen after they filed their tax returns for 2020, after they potentially paid taxes on the didn't deduct those expenses and thus increased their tax bill. So we're hopeful, I guess, that the IRS comes out and gives guidance specific to those situations too, because for those larger loans, those loans over $2 million, the process is going to take longer to audit and approve those loans. Jim?
Yeah, that's good. And I think it, the IRS is going to have to act on that, because again, if Congress doesn't, unless Congress gets into the point and actually passes legislation to allow those expenses to be deductible, which would be great, then the IRS is going to have to issue some guidance on some of these issues. Let's just briefly here, we've touched on this a little bit, Tommy, just or we can go through here that again, there's still a potential for another CARES 2 here before the end of the year, as far as leading up to the elections. There was some talk on they didn't get that far with it.
Yeah. So I think on this, I mean, we've been following since July, frankly, this second round of stimulus, which hasn't happened. The real obstacles that would appear are that the Republican caucus really wants a liability protection for businesses and employers, and the Democratic caucus really wants a large aid package for state and local governments, and those appear to be the major hurdles. For the most part, I think a second round of PPP for businesses that saw a significant revenue decrease, 50%. Is a number we've heard. Not sure exactly what time frame that would be part of that application, but a 50% increase in revenue over a certain time period. Unemployment benefits, there's no controversy over whether the federal government should provide some more subsidy there. It's just a matter of probably how much. And then testing, it's not at odds. It's really those two provisions, and now that we have a different president coming in and a different makeup of Congress, we'll see. Obviously, we're hopeful that for for those businesses most impacted, restaurants, hospitality, airline industry,
Mhm.
potentially retail, that happens sooner rather than later for the good of all of our communities. But if it doesn't, I would expect that after President Biden takes office, it'll probably be one of the first things he does in the spirit of really trying to recover from the pandemic, which I expect we'll see a lot of activity in the first half of 2021 around that.
Yeah,
Jim?
I think you're right. Is that if they don't get the stimulus here, before the end of the year, again, I think there's some need in certain areas to get that, sooner rather than later. But if they don't, I guess there'll be a push to have another stimulus, but it might not be till February or March by the time they get through that. So we'll have to keep an eye on that. Um, so anyway, we appreciate the items here. We've got a couple questions that have come in here. We'll kind of go through the questions now here. Some very insightful questions with it. There's one I'll just cover here briefly. Somebody asked about the Tax Cut Jobs Act. Why the Republicans didn't make that legislation permanent. A very good question with it. They did make some of the provisions permanent with it, and I think it just dealt with the this reconciliation and how much the budget afforded them that they could, put into this box of I think it was a trillion or 1.6 trillion or whatever the total package was that they had to fix, and there's special rules on what they could put within there, and it just allowed them for some items that they were able to make permanent, like the corporate tax rate cut down to 21. That's a permanent rate with it. Again, Congress could always change it, but there's no sunset with it, so that's scheduled to stay in place. This interest expense limitation that Tom talked about, that's a permanent change with it. They got some modifications to the calculation, but that's a permanent change. So there were some changes that were permanent, some that had a sunset with it, and it's all just because of the budget rules. I don't think they wanted to make it that way, but that's just what they were forced into with what they were able to package into the amount of money they had with it. So good question with it.
There's a couple questions on how does this affect merger and acquisition. Clearly, we baby boomers are a big part of the overall group of business owners today in our country still today. But as they age, they are looking to exit their businesses more and more, transfer that wealth, and so the taxability of that and how much they actually harvest from the business after tax is in question here as these tax rates change. But remember that tax policy, as Jim said, major tax policy happens probably once in a generation, right? 86, 2017, 31 years later, there'll be some tweaks. There might be some rate changes here negotiated because for example, there's a big push to do an infrastructure bill, or maybe there's an extension of some of the TCJA provisions that Republicans want and Democrats want, maybe some higher rates. There will be some of these things that will come out, but as it affects the business owners that want to transact their business, what I would say is start your planning early, right? If you're looking 3 years out, look at look at entity type and look at some of these changes you can make now to prepare yourself, and the timing, right? If you can do an installment sale, for example, and spread the proceeds out over a number of years and stay in a lower bracket, that's the way to go too. And then another audience question, Jim, that we had here was on whether if all of these tax changes really are sort of focused on the wealthy, could the Supreme Court rule in favor of prejudice and maybe overturn some of these tax laws? I'll let you take that one.
Yeah, I think again, if a bill goes through, Congress with it, goes through the House, and gets the Senate and meets all the congressional rules that they have in place and is signed in by President, I don't think there've been too many times where a tax law change has been ruled unconstitutional with it. So it's something to keep an eye on with it, that they have to navigate when they're putting the legislation through. I know that there's issues now with the Affordable Care Act that was almost a decade ago when that passed. It's been in the Supreme Court. Now it's on its second time to the Supreme Court with it as to certain aspects of the Affordable Care Act and whether that's constitutional or not. So there could be some challenges with it. But I guess we'll have to see what the final language is in the bill. And again, if what often would happen though is if there's a number of provisions within the bill, there might be one item that might draw um, a question with it, but it doesn't necessarily mean that the whole bill wouldn't still be effective. But good question with it. Something we'll have to keep an eye on with it. There's one other question, another one here that came in. Is there any discussion for relief for LIFO income with the significant drop in commodity costs? Good question. I haven't seen anything on that with it. I know that if you're on LIFO income, again, if you have a lot of inflation, again, LIFO provides a benefit for companies. And again, if their commodity costs are going up, they could benefit more with LIFO. It comes down, LIFO, works kind of the opposite way. If your costs are going down and LIFO is less beneficial with it. But I haven't seen anything where they might provide some specific relief with it. It's just something that you have to manage when you're on LIFO. You're just subject to some of the inflation that is out in the marketplace with it. So again, something to
Well,
keep an eye on with it.
Well, good news, Jim, for those buying ag commodities, as there's a huge run up in the price of some of the agriculture commodities here as we approach year
So
end.
they might benefit from the LIFO.
They might benefit.
Right, yeah.
I mean, China's buying a lot of our grains, and there's a lot of demand. So maybe for some there might be a benefit, but yeah, I haven't seen anything either on that. So
That may be something too, looking forward as far as a planning thing is, if a company is not on LIFO and is starting to see rising prices, especially with potential higher tax rates, either for business or individuals, LIFO may be something for a company to explore, whether it's this year or next year. So if you have that, please let us know. We can help you analyze that. LIFO is still available as a accounting method for inventory and a potential beneficial method. So.
There was one question on PPP too I want to address. Be careful when you're looking at the PPP effect on your taxable income. Remember, as Jim said, the proceeds are not taxable. That was in the CARES Act, the actual income, but the expenses incurred are not deductible. So depending on your financial reporting, if you still have the loan sitting in your liabilities on your books, then you know, and you've incurred those expenses already with the loan proceeds, then you probably do have a taxable, you have some non-deductible tax expenses there that you need to add back to get to what you think your taxable income is. It's a little bit confusing. So just be careful with that. Talk to your advisor about what your taxable income's looking like, and make sure that you share with them how your PPP loan is currently being reported, because as it's forgiven, you move it into income, and of course then you have non-taxable income offsetting non-deductible expenses, and so in that instance you really don't have any difference between what's being reported there versus your tax return, at least to the extent of the PPP loan. So but stay tuned on that. We hope that there's some more guidance and maybe congressional action on that. Yeah. So one more question came in here, Jim. For the Biden proposal to eliminate QBI deduction for those earning over 400K, would the proposal also likely affect those taxpayers with organizations already subject to taxable income under about 325K? So a great question, and I actually had some notes to address that. So the change to QBI would really affect those manufacturing business, those businesses that don't have an income limit. So remember, service businesses right now are subject to an income limit. What Jim was referring to was not those service businesses necessarily. So if you're a manufacturing business, a retail business, not a what's defined as a service business, you have an unlimited with some other limitation, but your QBI calculation is not limited to your income. Has some other limitations based on W-2 wages and the basis in your property. But
Right.
what Biden's proposal impacts are those that don't have that income limitation. Jim, do you agree with that?
Yeah, I think it would just be an overall scale back of that deduction, for those at the higher income range with it. So, and I guess my guess would be some type of phase down with it too. I don't think it would be right at 400. It would probably be from 400 over to maybe 600 that deduction would get phased out. And my guess is you had higher income, you're not going to be entitled to that deduction at all. But um, again, that deduction has been popular with a lot of closely held businesses, and I think there'd be some pushback if they scaled back on that. So we'll have to keep an eye on that one very closely with it. It is a complicated calculation, but that's what Congress came up with to try to help small businesses that are in what they call a pass-through, an S corporation or partnership, so they can get some lower rates from their business. Again, on the corporate rate side, it was easy just to change that rate down to 21%, but this 20% deduction, this QBI that Tom talked about, has a lot of complexities with it. But it's again designed to provide relief for those closely held small businesses that are a pass-through. So I think that's it. We had some other questions that we may get back to the people on it with it, but very, very insightful questions here. Very helpful with it.
So you want to slip to the last slide and we'll wrap up, Jim?
There we go.
Well, thank you all for being here today. If you have any additional questions related to our presentation, please submit those to us, and we will try to put together compile a list of Q&A that we can provide to the entire participant group. And let me be the first to, on behalf of all of us at Sikich, wish you a very happy Thanksgiving. And again, thank you for attending.
Thank you.